Welcome back to Upside Down Data. So in this video, I just want to share a couple of observations with you from the UDPI risk chart for Bitcoin, as well as the price chart on the weekly time frame. So if you guys like the content, subscribe to the channel, give the video a like, follow us on Twitter at Upside Down Data. We put out regular updates there about the market and about our risk indicator. So got the long-term UDPI up for Bitcoin here. This is meant to be interpreted on a scale of months. And so these risk indicators, these readings that we're looking at, are supposed to help guide your decision making on a long-term time frame. So keep that in mind as we're looking at this. And I want to share with you a kind of a bullish reading of this and a bearish one, because it's possible to interpret this information either way. And given the uncertainty in the market, having pulled back more than 40% from the new all-time high at 69K, I think we need to be prepared for each eventuality. So this is pretty straightforward, I think. Here we are, we're in the green territory here. I think that case kind of makes itself for a bullish interpretation. Historically speaking, when the risk level on a long-term basis pulls back into these rather oversold regions, past -2, let's say, and the reading right now is about -2.4, tends to be profitable, at least if you're not too choosy about the time frame that you get in and out. If you're willing to be patient and let the market come to you, these tend to be good times to accumulate. Now, if we wanted to look back over the course of history and try to find some instance that we could map onto the present, or that we could interpret the present in light of, I think we would clearly go back to 2013. This has been remarked on a lot by other people in the space, because 2013 is so far the only double peak cycle that Bitcoin has had. There was this first peak followed by a very significant drawdown, and during that drawdown, the risk moved all the way from above +2 down below -2, which preceded the next run up, which was even more parabolic, even more impressive, and the price became even more overextended, moving into this deep red territory, approaching +5. So that was a double peak cycle. If we were inclined to try to map that onto the present, to give a bullish reading on the present, we might interpret both of these dips, both this May to July 2021 dip and this current one, this December so far to January 2022 dip, as being an extended or more drawn out version of this first double peak cycle. Some people have proposed that maybe we're setting up for a triple peak cycle, where the second peak that happened in October up at 69K was kind of a mini peak. It didn't exceed the previous peak at 64K by very much, and there were divergences on the momentum indicators already showing there. The RSI made a lower high, for example, which was a clue that perhaps it was a bit of a fake out. Although in the heat of the moment, that's hard to know. But in retrospect, that certainly seems to be a reasonable way to interpret that. And so maybe this is all part of a 2022 version of this interim period back in 2013. We're gearing up for the final impulse move of the cycle. That's a hypothesis. I think that some people are expecting that, and it seems to me that it's reasonable. We do have diminishing volatility, and we have lengthening cycles, as some people have remarked. So it seems possible that what was one dip back in 2013 between the first peak and the second peak would be two dips back, nowadays in 2021, 2022, before that, real second peak, or what we could call third peak. That would be a bullish reading on this. I think the bearish reading also kind of makes itself. If we're just looking at this same chart, the fact is that at no point in the price history of Bitcoin, during no cycle, has risk reached the red zone more than once. Even in 2013, the first peak did not reach such an elevated level of risk. It was actually only a moderate level of risk on the long-term price chart. And it took until that second blow off top for us to see real overextension on the risk chart. But in 2021, in the early part of the year, we did see that degree of overextension. Maybe not quite as much, but it definitely got into the red zone. It was very high risk, and we have not returned to that level. And if we assume that that's a once per cycle thing, then that would be a bearish read on this chart. So both are possible. I think that it's important to try to push ourselves to consider both. I'm uh, a bull by instinct, and I've been more convinced personally by the bullish arguments about the long-term trajectory of this cycle. I still am, honestly. I think the thing that is most persuasive to me, I'm going to pull up the price chart again. We're just going to look at the price chart here on the weekly time frame. What really doesn't sit right with me about the idea of a bear market, and again, I'm not saying that this should necessarily be so persuasive to you, but the thing that doesn't sit right with me is that we didn't have a blow off top at all. This price action in the early part of 2021 was rounded. It it was not euphoric to the degree that you would expect to see a bubble before it bursts. And what that tells me is that there's no technical structural reason on the price chart that we have to get an extended drawdown past the current level where we are now in the low 40%. A 40% drawdown or even a 45% drawdown is par for the course in the history of Bitcoin bull markets. If the price were to bounce here, the integrity of the bull market by historical standards would remain intact. And it seems to me like a drawdown of 80% or something like that. When people are thinking of when they talk about a full-fledged bear market would make more sense if it had been preceded by a blow-off top. Price action that wouldn't leave much of an order book behind. There wouldn't be a lot of support on the way down. There wouldn't be a lot of volume that had been traded in the past just below the high. That's not at all what we see here, though. We have, a pretty thick trade history here. We're looking just at the volume profile. See that a ton of volume has been traded just below where we are now. And so we're sitting on top of this stacked history, which isn't the case at the top of previous bull markets. So it just doesn't seem like the dynamics to me that would lead into a full-fledged multi-year bear market where we reach unimaginable lows and cause, extreme losses for people. That doesn't mean it can't happen. I've said in the past, things are changing. This is a young asset. I think we do have to expect the unprecedented. So that would be unprecedented if we, had a rolling top, this kind of rounded action, no blow off, and then, a bear market of the same magnitude in spite of that. That would be unprecedented. But what would also be unprecedented would be a triple peak cycle. So I think we're headed for something new, one way or the other. So we have to push ourselves to be flexible and to use our imaginations here in considering different possibilities. Another bearish data point here, if we want it. I'm pulling up the short-term UDPI chart. This is much more reactive, but it still can be useful if to look at on a long-term time frame. And one thing we can glean from doing so is that we see that on the short term, back in 2013, we did reach that overextended, that red zone, that deep red zone past +4, and we reached it twice. Both peaks got that overextended. And here too, we've reached that a second time. It was brief on the short term UDPI chart, but it did reach that red zone twice this cycle. So again, that would be a different form of rhyming, right? And so if we're going to make another peak, then presumably we're probably going to get back up to that overextended level again on the short term. So that would be another unprecedented thing. So expect the unprecedented one way or another, whatever your bias might be. One last thing I'll share with you guys, because I think this is pretty interesting and is by no means diagnostic. It doesn't tell us what's going to happen. But speaking of rhyming, I think that this is a little bit too much of a rhyme to go without mentioning. And that's that the fractal, the price action that's playing out right now, is kind of eerily similar to what we saw back in the spring and summer of 2021. And specifically, what I'll draw your attention to is that after this big capitulation and this wick at the beginning of this bear move, the price consolidated for a month, 4 weeks, and then in the fifth week, the price made a new low. That low, right here, that fifth week after that initial drop, pulled down 5% below that initial wick. Right now, the price is sitting just below that initial wick in the fifth week again, so we have that kind of rhyming. So 5 weeks after that initial drawdown, we make a new low. And if the price were to drop 5% below that low, it would take us to about 39,800. That's, interestingly, confluent with the beginning of this kind of high volume historical range, where just below 40K, especially around 38K, but even a little bit higher than that, we see that there's been a lot of volume that's been traded in the past. That suggests that it's a very strong support region. We could be setting up for another kind of spring type of action. You know, everyone was a Wyckoff expert back in the summer. If you were around for that, talking about Wyckoff reaccumulation and this spring and back into a bull market. The spring just refers to this big wick when the price makes a new low and then gets bought up really quickly. And so here we are watching to see whether that's going to happen. You know, the fact that this is rhyming is not in and of itself a great argument to expect it to happen again, because it's right there on the chart. Anyone can see it, right? And so market makers are aware of this and don't want to make it too easy for the rest of us. So maybe this is a big fake out. Maybe it's a ploy to get people to look for that spring, and then the price is going to make a new low and continue downwards. It's entirely possible. But it does give us something to watch because there's some confluence there. And so if we were to see in the near future a big buyback up, let's say to 45K, particularly if that were to happen before the end of this week, so you know, in the next 24 hours or so, that would provide, you know, a data point which would be suggestive or would be consistent with the idea that maybe there's a spring happening there and maybe we're going to consolidate a little bit more and then go on our merry way. If we wanted to get really specific about it, we could look for that spring type of action. We would want to see a close a little bit higher than we are now, you know, closer to 45K, and then we would want to see a few more weeks of consolidation, maybe grinding down and in a kind of a flagging type of motion on low volume, just like we saw back then. And then in that fourth week, 4 weeks from now, and about a month from now, if we saw a big bounce to the upside, well, that would be you know, kind of a full replication of that whole multi-month move that lasted about 3 months. So it's just something to watch. Doesn't have to play out that way, but I thought it was interesting enough to mention. So some thoughts to share with you guys. Hope you're hanging in there during this uncertain time. Be careful out there. Try to keep some powder dry if you can, because if it pulls back farther, you'll want to have some cash on hand, because the lower it goes, the better the buying opportunity. So I hope you found this useful. Thanks for watching.